Efter en lång tids kräftgång stiger oljepriset på bred front och till och med Texas-oljan har handlats över $80. Med oss för att förklara drivkrafterna bakom den här utvecklingen har vi Nadia Martin Wiggen. She's an investor and an energy expert with Norwegian Svelland Capital. It's wonderful to have you with us, Nadia. It's been quite a sentiment shift in oil in the last couple of days or weeks. What are your thoughts on the moves?
Yes, absolutely. When we think of where the market was placed in November, December last year, I mean, first of all, the volatility disappeared. So a lot of investors just moved away from the asset class. And after the Trump election, the focus was on tariffs and therefore negative impacts on demand for oil. As a result, going into year end, the market was leaned towards the negative side, shorting the market, and all the algorithmic trading signals were pointing southwards. When we then turn to the start of this year, though, and we look at where the year ended in terms of inventories, we are actually at very low inventory levels. In the US in particular, at Cushing, we are at rock bottom. And so the signal to traders is that we need crude. And when you look at the backwardation in the Brent curve that we've seen since the start of the year, it's incredible. And it points to a much higher oil price than what we've hit so far, in the lower half of the 80s.
This is very interesting. So it's essentially a tightness, a lack of oil that's the major price driver as of lately. Is that correct?
Yes. And it's driven, number one, by the fact that, in our view, China bottomed out in terms of oil demand in November, December. Going into the fourth quarter, Chinese oil demand was actually negative year on year after having grown 1.6 million barrels per day the year before, when global growth last year in total for oil demand was forecast by the IEA to be sub 1 million barrels per day. So it's a big difference when you have the world's largest oil importer starting to buy oil again. And we saw them back in the market in November, issuing emergency import quotas and diesel exports falling quite dramatically, indicating that internal demand for diesel in China was much better than the market had expected.
Good news then. Could you humor me with a 1-minute explanation of the term contango backwardation? You mentioned the backwardation of the curve, just for those who didn't follow that.
No. So backwardation means that if you're buying oil today, you're willing to pay more for that than for oil that is delivered in 2 months or 3 months. And this is what happens when there's an acute shortage of oil and there's a scramble by refiners, by traders to buy oil from anyone. Conversely, when you have contango, it means that nobody actually needs the oil right now. So you have to buy it and stick it into storage. And the cost of storage costs something. Mm-hmm. Therefore, you want to buy it today at a discount to pay for your storage to actually deliver it to somebody else in 3 months.
Thank you. That's a very helpful reminder. Another Oil 101 dynamic that hasn't been working as of lately is, of course, its geopolitical unrest in the Middle East should push oil prices up. It didn't last year, and now, ironically, we get good news, a ceasefire in the Middle East, and what happens? Oil prices goes up instead of down. Why is that?
In our view at Svelland Capital, it's because the main criticism that Netanyahu has had from the Israeli people in terms of his tough stance towards Hamas, Gaza, and Iran has been that the hostages have not been returned. This ceasefire deal means that 33 hostages, which could be all of the hostages that are still alive, are being returned. So once he has that out of the way, in terms of getting back everyone that is possible, he has an open way to go fully after Iran if he chooses to. And that's where the geopolitical risk is higher for oil, because if Iran is in a direct war with Israel, if the U.S. already is talking about being harder on Iran, we could lose 1 million barrels per day of oil supply out of Iran that is supposedly sanctions, but completely allowed to go out, basically, in practice, that we could lose that supply from the market overnight at a time when Saudi Arabia has not said they're coming back immediately with oil.
This is very fascinating. So what appears as a risk-off, a positive piece of news, actually paves the way for a more dire scenario, albeit a risk, not a certain
Yes.
fact right now.
A higher risk, exactly.
Speaking of high risks, Mr. Donald Trump will obviously be inaugurated as president on Monday. He's an oil-friendly candidate and politician. Do we know what, if any, impact his presidency might have on markets?
Well, it will probably have lots of impacts. The direction of the impact is what is less certain. He is a big negotiator, a big talker, but he also is a deal maker. So since, his entire campaign was very focused on having tariffs with trading partners of the US, some tariffs will come. However, it is completely unknown at this moment, which tariffs will come and in which order. And this is where, on the oil side in particular, we've had these sanctions on Russian crude producers, two of the biggest ones, as well as having a lot of ships put under sanctions by the Biden administration last Friday, which created this additional impetus on the oil price. And Trump didn't come out on X saying this is the dumbest thing Biden should have done, which suggests that he doesn't mind this kind of pressure on Putin as he thinks about going into negotiations between Putin and Zelensky to try to find a way to end that war in Ukraine. Trump has pulled back on a 24-hour scenario, more towards 100 days, 6 months before something is resolved. But that's not a certain thing either, that he will continue on that course. He could decide to go the other way and say, all right, Putin, if you stop asking for complete surrender, which is essentially reading between the lines what Putin is saying, we'll take off your sanctions. But we will, maybe we'll flood the market in oil and you just run out of money. So you'll be forced to surrender, or not surrender, but forced to actually negotiate so Ukraine doesn't have to fully surrender. And Trump can do that with Saudi help because Saudi Arabia and OPEC are sitting on, 2.5 million barrels per day of spare capacity that can be deployed very, very quickly. The IEA believes they have 5 million barrels per day of spare capacity. So they can step in there and start to replace the 1 to 2 million barrels per day of Russian oil that should come under very direct sanctions right now.
That's also a very interesting point. So in summary, when I look at Trump on Monday, I'll be looking at the geopolitical puzzle, the relation to Russia, when I want to focus on oil prices, not so much whether the US actually drills more or if it gets easier to get a permit.
Yeah, I mean, that part is helping, and that's a lot of the up movement that we've seen, especially for companies like Exxon since November. That is already being priced in. The big game changer, and that is actually on the natural gas side in LNG. And this is where it's critical for Trump to negotiate with Xi. He's just come out saying they had a very positive talk. And in our view at Svelland Capital, he wants to break that relationship between Xi and Putin. Putin right now is the cheapest oil and gas provider for China. Trump wants to replace some of those volumes, or preferably all the volumes, with American oil and gas in the long term. And that is much more of that game plan of drill, baby, drill, and building out that industry, because the US has a tremendous amount of natural gas reserves.
And this is a tremendously interesting development to follow and conversation to have. Nadia Martin Wiggen, this is very, very interesting. I hope we can talk again soon. Very happy to have you on this conversation. Happy Friday and have a good weekend.
Thank you. Absolutely. Looking forward to next time. Thank you.
Bye-bye.